Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil markets. I'll start with Paris rapeseed. The move down since mid-May petered out in the middle of last week as prices approached the rising short medium moving average, currently 490.5, and promptly volte-faced with a bull hammer pattern. This was followed last Thursday by, I think, the longest bullish long white Mariposa I've seen in this market. However, the rally was in uncluttered space, no significant congestion, apart from some April congestion in the 500 to 503 area, before the market stopped dead on the threshold of the congestion zone 513 3/4 to 519.5, and that's dating from September 2012. This held down prices until last Tuesday, when with a bullish opening long white Mariposa, the market punched up through this congestion and halted at the previous all-time high from July 2012 at 524 3/4. Then yesterday prices gapped higher, which was kind of ironic as the move up filled in the previous gap left by the island top from May between 527 1/4 and 532 even. Anyway, we ended up with an indecisive doji cross on the day. Not what you'd like to see if you're a bull so close to the all-time high in May. However, today the market started to exhibit some bullish incentive, at least at the start, as it gapped higher, since filled and managed to reach up to the 535 area before ending up as another indecisive pattern. This time an indecisive spinning top, once again right at the height of the market. I've drawn a fresh late April to late May acute bullish Andrews pitchfork. It is early yet, but this pitchfork, despite its acute nature, has shown some promise in tracking the bullish angle of attack of the market between the lower time, currently 501 1/4, and the middle time, currently 544 3/4. So this one is for all those who have a bullish nature. What about those who have a bearish tendency? Well, I'd like to reprise something I spoke about last week that fits in with the recent moves higher and the current hesitation. I quote, "There's another thing related to this which I'd like to discuss. This is way too early, but perhaps, just perhaps, we may have the makings of a possible head and shoulders top emerging from mid-April to date, and using the bottom of the two hammers as the neckline. Currently that's actually at 487.5. This is just a speculative thought right now, but if the market were to somehow turn around back down before reaching the highs of the 540s, then it might be a valid idea. I just wanted to make it known here rather than just let it rattle around in my head alone." End of quote. There you have it, two possible scenarios, and I wonder which one will turn out to be more valid than the other. Winnipeg canola. 2 weeks ago I spoke about three interesting things seen here since the fall in early May, and I quote, "Firstly, we had a gap on the way down at the same price level as on the way up in the previous week, leading to a gap between 894 and 896.10. This also means that prices have not traded at those levels ever. And this also means that we have an island formed over early May. There is no price target there as it relates to my second point and the elephant in the room. The change gap from last week between 828.10 and 746. A bigger one than usual, but one of the things I have to put up with if you use, as I do, continuation charts. Anyway, a target X, if I had bothered to draw it, would have been in that gap. Finally, my third point. This related to the action this week, which is actually now last week. We have seen two indecisive patterns already and probably a third on the way, with a possible bullish hammer action as well. It's all indicative of indecision at these levels. There is some congestion here between 702.70 and 729.10, though we do have the overhead rising medium moving average. That's currently at 751.10, capping the action as well. However, I have a suspicion that the 2021 uptrend, currently that's at 719.40, may have something to do with it, and not as an uptrend but as a version of a bearish bump and run reversal type formed over 2021. It is not a clear pattern at all, and I can see many arguments against it. End of quote. As you can see, the key action to look at is what the market does, or does and may do, around the 2021 uptrend, and I suppose by inference what it also does around the late October 2020 to date uptrend, currently at 716.90. Now last week the market broke down through both and some considerable way down to the long moving average. However, by Tuesday last week we'd formed a bull hammer, the second one in this move, as the previous week we'd also had one. Anyway, the market rose back up into the mix of congestion and uptrends between 702.70 and 729.10. We'd next had another bull action this past Monday, which did the trick and pushed up prices such that we'd risen up to test yesterday the next significant overhead resistance. That's the medium moving average, currently at 751 even. I've already pointed out earlier that this was an important level overhead, and so it has proved to be. As though today we've punched up through it, the market ran into a brick wall formed from the 50% Fibonacci line of the October 2020 to May 2021 move, which is just over it at 761 even, and has reverted back down below the medium moving average, and that is where we are now. Question now is, will the medium moving average continue to cap this market? Because if it does, then the chances of a possible bearish bump and run reversal top just increased. You see, you could expect a little pullback and hesitation from the uptrends as part of the pattern in such a move. So it pays. Watch this space. Bursa Malaysia crude palm oil. So, surprise, surprise, we still have mid-October 2020 to late January 2021 bullish shift pitchfork, showing a bullish angle of attack of this market. Additionally, I've left on the broken, slightly more acute bullish shift pitchfork for the January to late March move. As though the pitchfork has been broken, I'm still minded to look kindly upon it. So what has happened? Well, 3 weeks ago the market reached target X in the 46.75 area. This is the target from the January low based bullish halfway hesitation pattern. And 2 weeks ago prices dropped off a cliff, all the way down, hesitating for a little while at 4 support levels. The first one, short medium moving average, currently 41.38. The second one, the lower time of the more recent bullish shift pitchfork, currently at 41.29. The third one, the recent 50% Fibonacci line at 40.10. Though I could add also, I suppose, the nearby February 2011 high at 39.86 in on this, but I suspect its effects were minimal. Finally, and the key to why the market stopped and then reverted back up, the flatlining medium moving average, currently at 39.70. This medium moving average caused the move up yesterday and the gapping higher move today. That's what has happened. Now comes the conundrum. You see, we have two conflicting patterns in store, or rather one pattern and one possible pattern. You see, on the one hand, today's action could be seen as a gapping higher bearish opening black Mariboso, and that is fine. However, it could also be seen as a more bearish belt hold pattern. Now, bearish belt hold patterns are seen both traditionally and by the data as bearish, quite bearish. Something like 7 out of 10 patterns turn out to be true. Now, admittedly, this one is a little in the wrong place, but that doesn't deny its existence. Then there's the thing on the other hand, or potentially the other side. You see, this week's move up has already set the criteria for it to be a weekly key reversal. So if we close tomorrow either over 41.70 or below 41.64, then we'd be on. Now, as of today, we're looking at a weekly key reversal up. But if the bearish belt hold takes charge and we move lower, then we would seemingly be endorsing the bearish incentive, and the medium moving average may come back into play. Now, I'll finish with something I spoke about last week, which I can also add to the cooking pot. It's quite an interesting piece. I quote, "My one cause of concern is that the action this week," so that is last week now, "is just a halfway hesitation. If that were to be the case, then we could see the market trade down to the 3600 area, close to the long moving average, currently at 3573. At the moment, this is just a cause of concern in the back of my mind, but I'd rather say it than not and look even more foolish. End of quote. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.